Scott is recognized.
Yeah, thank you, Mr. Chairman. Mrs. Wong, we've heard a lot about the taxpayers' interest in this. Can you tell me what interest the taxpayer has, especially if we do nothing, what the taxpayer may be on the hook for?
Yes, our concern is that there's a huge liability out there now, but if we don't do anything, that liability will grow. And although the taxpayer isn't technically on the hook for the PBGC, I think we can all agree that we don't think Congress will stand by and do nothing if the PBGC goes bankrupt. And it's really it's not a question of if or when, it's not a question of if, but of when. And so if we can address this issue now, looking at it from a taxpayer perspective, it seems more responsible than waiting until the problem's even greater.
Are you suggesting there's a moral obligation to make sure the PBGC pays what it has guaranteed, even if it runs out of money, that we have a moral obligation to replace the money?
I think Congress will have a political preference to make sure the PBGC pays those benefits.
And we'd be on the hook for other things like people aren't getting pensions and not paying taxes?
And I don't have those numbers in front of me, but I can get them. There have been studies done talking about the loss of pension benefits and the impact that will have on the economy. And those losses will be made up somewhere, and we think they'll be made up on the public services.
You mean like safety net, food stamps, Medicaid?
Exactly.
And so if we don't do anything, we have the taxpayers really on the hook for, right now, unknown billions of dollars.
Yes.
Do you know how many companies may be in a situation where their withdrawal liability exceeds the net value of the company?
I do not have a specific number, but we hear from quite a few employers daily.
Ms. Moorcamp, you indicated some problems and Mr. Blackman talked about problems running a business with this liability hanging over your head. Is that liability, is the pension potential liability of the listed on your financial report?
I can answer that.
Okay, thank you.
On our audit reports, we are formally audited every year. The withdrawal liability is listed as a contingent liability. It's on the notes to our financial statement. It's not on our balance sheet.
Do potential creditors, lenders look at that and become reluctant to lend you any money because of that?
Well, I'm happy to say that we've had the same lender for 72 years. That lender has told us that we've earned the right to have a contingent liability. Not all of their customers are treated with that degree of trust. So I would say, though, that from a practical standpoint, it does limit our borrowing ability because even our bank, which trusts us, they would require a personal guarantee for any large long-term loan that we would ask for. They already have a personal guarantee on our line of credit. So from an operational and a business planning standpoint, if I'm not prepared to personally pay back that loan, then I won't take it out. And what's concerning about this withdrawal liability is that it seems to be an uncontrollable figure. So to my mind, the risk associated with taking out another long-term loan is prohibitive.
Thank you.
Scott, can I fill in as well? Our lenders have told us that when assessing our credit quality, our lenders as well as our rating agencies are adjusting our credit statistics to take into account our unfunded pension liabilities, which leads to higher interest rates and higher cost of capital. And anecdotally, we do understand that there are rating agencies that use a withdrawal liability number, and then they either increase the liabilities or reduce the EBITDA by a percentage of the withdrawal liability, and either way, it leads to a higher credit risk and a higher cost of capital.
Thank you. And let me follow. I think you indicated, Ms. Moorcamp, that you pay what's negotiated under the collective bargaining agreement. Is that adjusted to reflect what is needed to keep the pension fund, solvent?
So we have a negotiated contribution rate, but we have plans that are under rehabilitation plans, and there are funding increases that we have seen as a result of that, some as high as 225% over what they had been prior.
Thank you, Mr. Scott.